Hi, this is Sean Overton with OneStepRemove.com. In this video I have Bobby Richards. Bobby is a former prop trader, means he traded professionally. Now he only manages his own account. Bobby's with us today to talk about his experience and how he made the transition from being a retail Forex trader into a pro trader into a guy that trades his own money at home every single day. Bobby, thanks for joining me.
Yeah, thanks for having me.
So, how did you get into Forex trading?
Well, so early on, kind of right out of high school, I was visiting some friends in Europe, and you know, obviously getting off the plane, changing money, you realize, you know, hey, why am I getting $20 less than what I thought I was going to get? So being exposed to exchange rates like that kind of piqued my interest, and just kind of evolved from there to learning more about it. And you know, at that time, retail FX was kind of becoming available, so it was something that I could kind of play around with a little bit.
Okay, and then how did you, so you're trading retail, you just came back from backpacking in Europe. How did your trading go?
Horribly. From what I can tell, the experience was pretty typical. Just, you know, lost a bunch of money, still thought it was cool.
Okay.
But yeah, I mean, my experience I think is on par with a lot of people.
And then you went from losing money as a retail trader, and then somehow you made your way into a prop shop where you're trading money professionally.
Correct.
So how does that happen?
So I've got somewhat of a technical background, and I kind of learned early on that utilizing some of that to help me with my patience and my discipline was kind of what really took me to the next level. So I was able to you know, handle some of the things I did poorly in a more technical manner. So taking some of that emotion out of the picture.
And was that before or after you got hired?
That was before. So I was kind of on my own trading. You know, as most of you guys can probably relate, it gets kind of lonely. You know, you're kind of bored. So the opportunity came up here in Austin, and I jumped on it. So
you didn't have some kind of stellar track record. You went from losing money to just making a little bit.
Correct. And that's the cool thing with some of the prop shops. I mean, you know, for them it's a numbers game, so they're willing to take that risk because you know, out of 1 out of every 10 or 20 people they train is going to produce. So that's, you know, so it wasn't extremely hard to get in the door, but it was a great opportunity. I loved every second of it. Okay,
and just for people watching that don't know what a prop shop is, what is a prop shop?
It's similar to a hedge fund, but you're trading essentially the firm's money. You have your own allocation, your own buying power. You have, you know, you're going to start off with a limited kind of risk profile, but you know, as you get better and as you mature as a trader, you get to take on more and more risk. So you're trading the firm's money.
But you are a pro trader.
Correct.
Okay, and if somebody wanted to get in, they decide they want to be a pro trader, they're doing okay in their trading account, what do they do? How would somebody find that?
You know, it's difficult now just because of the way everything's changed. You know, the prop shops that I know are not as willing to take new traders on. Things have gotten a lot tougher. Regulations have changed. The technology costs are they're not a driving factor, but things are shifting more to a technology-based trading setup. So it's just not the same environment as it was, you know, 4 or 5 years ago. As you know, should be quite obvious, but
yeah, it's changed a lot. Right. So, tell me a little bit about your trading style. When you were working as a prop trader, you weren't even trading Forex; you were trading equities.
Correct. It was equities. You know, again, kind of the same deal with the retail. You know, I made great decisions, but just the execution just was not there. So, I'm a very kind of impatient person. So, I don't do well sitting, staring at a screen all day. You know, because you force the action. You're trying to make something happen. You get bored. You know, conversely, the best traders I knew were able to sit there and just, you know, they followed their plan to a T. They were very, very patient, very disciplined, and they did well. That wasn't me, unfortunately.
So you were able to overcome that, but that was because you're like me. You like to program.
Correct.
You like to do statistics.
Correct.
So what is that? Tell me a little bit about how you analyze your trades.
Well, so I take a somewhat different approach, is I think a lot of the kind of prevailing, I don't know if you'd call it wisdom, but just how things go right now. So I do more of a post-trade analysis. So I'm kind of the mindset that there are a million and one ways to make money. You know, I wasn't specifically looking for one kind of uber strategy or something that would just kind of solve all my problems. I mean, it was a learning process. I wanted to see how I reacted to the markets, how I placed my orders. Execution is such a huge piece that I think a lot of people don't pay enough attention to. A lot of it is how to find the trades, but there's a whole nother world of how do you actually execute that trade.
Okay.
And so I started focusing on that, and that's where I really started to see gains in my P&L.
So you were placing trades manually.
Correct.
And then you're going back and looking at it, and then you're saying, oh, I could have done this better, I could have done this better, and that involves a lot of work after the market's closed.
Sure.
Okay.
Again, how you react to the market is really the only proprietary information that you have. So, what do you do well? What can you, where can you increase your size? Where should you decrease your size or just not trade altogether? I mean, what symbols are you trading well? What symbols are you not trading well? I mean, there's a lot to take into account of, after the fact, so to speak, and not so much like, how am I going to get into this trade? But okay, I'm going to get in, but what am I going to do? How am I going to place my order?
Okay.
How can I optimize my orders?
And so while you're doing all that analysis, that naturally leads to programming and algorithms.
Yeah.
So what's the balance for you between manually trading and getting that discretionary information that is unique to you, but taking advantage of your programming background and finding potential edges in the market?
Right. Well, so that's definitely one of the reasons that I moved solely into FX, just because the amount of information is so much less than the equity markets.
Right.
I can consume an entire FX feed on my laptop. I can do all the analysis I want. So that was really kind of a business decision. Okay. As far as the technology goes. So I'm able to do those bits of analysis without needing, massive data feeds and servers, and so I wanted to narrowly focus the universe of what I was looking at, and FX is perfect for that.
Okay. And when you were working on the prop desk, there's a lot of camaraderie there.
Right.
So what's that like when you make the transition from working with a bunch of guys that are joking around and then you're buying?
It's tough, but at the same time I felt like my trading matured a little bit because I'm not sitting in front of a screen all day. I'm not trying to force action. I'm waiting for the market to send me signals, essentially, and then I'll act upon those. But I think a lot of you guys will probably be in that same situation. You're thinking you want to do this full time, but the good news is it doesn't have to be full time, and it might be best that it's not a full time endeavor. It opens you up to be able to do other things, the things that you're passionate about, and then
ranching.
Yeah, absolutely. Gardening, ranching, chasing your goats around, but you're able to spend more time doing what you want to do rather than sitting, hoping something happens or forcing something to happen, and that's where you lose money. I think everyone knows that.
Okay. And then when you're looking for trades, is there any specific factors that you're looking for? Do you have like a system for your discretionary trades before it goes through your gray box?
Right. I definitely have things that I look for. They're simple in nature, nothing overly complex. I look for price levels. I think major price levels drive FX for the most part. So if you can identify those and then learn how to kind of position your orders around those, I think you'll be ahead of the game, so to speak.
Okay. And then what's the transition like for you? You were in a prop shop, right, and then you wrote some kind of software to help you with all this post-trade analysis. Right. How did that help you transition into trading by yourself?
Oh, it was just natural. Again, I don't know that I would consider myself a day trader anymore. Leveraging these tools helped me to focus my efforts, right, and really kind of optimize what I'm doing. So, I don't know. It's tough to label it right now what I am. That was an awesome time period of my life. I'm still extremely good friends with a lot of those guys. We see each other a lot. We still hang out, but I don't know. I don't know if I think of myself as a trader anymore.
Okay.
But just kind of, I'm kind of managing what I've accumulated, and
right.
I still think FX is a decent way to do that.
Okay. And in terms of hours per week, how much time does it actually take you to trade?
So most of the analysis is done on the weekends. I mean, one of the really nice things about the financial markets is you have that kind of natural break of the weekends.
Right.
So you can just step back, kind of get a clear head and look at the week ahead without any other, you're not getting any signals or alerts, or you're not worrying about positions. I mean, the market's closed, so that's nice. So most of the work is on the weekends. So you want to have a good plan in place, and then just rely on your signals, on your rules, during the week, which, is the hardest part about it,
right?
Obviously, but I think leveraging technology to help with that is a great way to go.
Okay, and can you tell me a little bit about the software FX Ticker? You use the Coke analogy,
right?
And I just watched you buy a Coke,
right? Yeah, it's a great analogy.
So if you had something between you and the Coke, then you wouldn't have to worry about drinking all the extra sugar.
Correct.
So how does that apply to trading?
So we'll try to take that into trading, but you want something between yourself and the market.
Okay.
Right? You want a risk management piece in there. I think that's one thing that kind of new FX traders and a lot of them don't benefit from. At these funds, prop shops, hedge funds, you have that back office there to manage the risk for you. So, for instance, if you're trying to place a trade and you're outside your risk parameters, it'll just deny the trade.
Okay. And that's when you're working in a professional environment.
Correct.
Okay.
So, I mean, if you're, trying to buy something you shouldn't, if you're trying to short something you can't borrow, it's going to prevent you from doing that. Okay. So you want kind of, there's nothing in place. So, I mean, it really is, it's all on you to maintain that patience and discipline. And let's face it, not a lot of us can, and nor do we really need to. I don't think you need to beat yourself up if you constantly, are breaking your rules, because that's just natural.
Okay.
But if you can identify that and use some kind of risk management piece, I think that's when you can start seeing gains in your trading. You may not be wildly profitable, but I can almost promise that you'll be very close to break even at least.
Okay.
Which is.
That's a huge gain for most retail traders.
It's a step in the right direction. So, it really, it's like when I'm playing golf. Like I'm a fairly good golfer, but like one or two holes, I just blow up, right? And it just ruins the whole day for me. And I think that's the experience most traders have, is that, they're doing fine, but it's just one or two trades that just, if they would have been kind of managed, from a
coulda, shoulda.
Yeah, from a risk perspective, you may have been able to eliminate those, or mitigate that loss, or something like that. So I think it's important to find something that helps you manage your risk in your trading.
Okay. And then when you came up with this software, you made it for yourself.
Correct.
But it was originally rolled out for your friends that were also prop traders.
Yeah, so it's gone over years of evolution, but I created it for myself because, like we said previously, I was horrible at just sitting. I was a horrible screen trader.
Okay.
I made good decisions, but the execution was just not there. Revenge trading at the wrong time, trading the wrong size, not knowing when to stop, but conversely, not knowing when to step on the gas. Not knowing when you have, when the conditions are right. And kind of going for the juggler, so to speak. I mean, that's not only do you want to mitigate the losses, but when you're right, you want to really hit a home run. Yeah. So I created this software for myself. The core group of guys that I traded with use it as well. And now that technology costs have really come down, we're kind of releasing it to retail traders, because I think it's tough when you're on your own, and you're kind of just left to your own devices. I mean, and it's a negative kind of emotional feedback when you know you shouldn't be doing this, but you are. Then you beat yourself up, and it just kind of is this vicious cycle.
Right.
So so the idea is, let's take for instance a simple moving average cross, right? Just for oversimplification, when that happens, there's going to be, the market's going to be different. It could happen, let's say 20 times in a month, but one day it's a tier 1 news event, non-farm or Fed minutes day or something like that. Sometimes it could be low volatility, high volatility. You're near like the 10-year top in euro or something. I mean, so you can't just spend all this time coming up with your algorithm and then just expect to run it kind of the same overall market conditions. You have to understand.
So you're not a fan of the 5 and 10 year back test?
No, I'm not, and that'll probably may turn a lot of people off. But I mean, you look at what's happened over the last 5 years, and you also have to think too. I mean, these hedge funds employ very smart people, and and along with the smart people, is they have huge budgets for technology. So when you're back testing a 510 cross, 5 years ago Citadel was running like something like 180,000 options simulations a second.
Okay.
So I mean, if there's a pattern, it's probably going to be found and become an anti-pattern pretty quickly. So, but again, not to discourage. I mean, I think that's to your advantage. Like, you don't want to focus on the idea creation. I think you want to focus on the execution and like the post-trade analysis. So, for example, going back to that moving average cross, if I get my signal and I mark it in, meaning I just want to take whatever price, I want to get into the trade, I want to buy, I want to go long. Even on Euro, a tight spread of 1 pip over the course of 100 trades, you're at a 100 pip deficit, which is huge.
Yeah.
So kind of the mindset that I have is, okay, let's look at those and see what happened. And for another simple example, let's say 80% of those trades drew down 7 pips, right? Okay, so I'm probably going to be doing myself a favor if I would adjust my order to when that signal happens, not taking the market price, but putting a bid out 7 pips below. Now, that's not going to guarantee me a winner or any more profit, but you're going to be putting yourself in a much better position to profit from that trade, because you're recognizing that statistically this happens, and it's just better if I kind of.
So this is the process that you called the post-trade analysis.
Right.
You're looking at your trades,
right,
and you're looking at the data, and you're saying, if I would have put my order 5 pips lower and just waited 5 minutes to get filled, would have been 5 pips better.
Yeah, I think I can remember 2 trades in my entire life that I got in on the bid of the offer and it never went against me. So we all know you're going to get into a trade, it's going to go against you some, right? So that being said, and that's where it's hard to be patient, because on the flip side, you have the fear of missing out. There's been times where I've been patient, I've been disciplined. You put your order in, and then it's like it's screaming to your target, laughing at you the whole way.
Right.
Like it never even goes against you. And I mean, that's frustrating too. But you have to understand that doesn't weigh out statistically. I mean, that's a statistical anomaly. Like that just doesn't equate. So, and as much as that will hurt, you can't let it bother you. But at the same time, if you're kind of abstracting yourself away from the actual market, you're not going to be as emotionally impacted by missing out, because you may not even be aware of it. If you're saying, okay, I've got my alert, I want to buy Euro, and then your risk system decides where to place the order, how to size it, you may never know that you missed the perfect trade. So I think that helps too, by kind of removing you a little bit from the trading.
You have a really technical background, but unlike most people, you haven't dove headfirst into algorithmic automated trading.
Right.
Right. How do you balance the automated component versus keeping you from the coax?
So when I think of automation, I think of it as automating your trading process, not as finding this godlike indicator, right? So again, I want to see how I react to the market, and 2, when you're trading manually, you're connected to the market. You're reacting, you're seeing what's going on, but you also have the confidence to know that if I can place this myself, that when the time comes, I can jack up my size. I can take whatever size I want, right? You also have the confidence that if I need to intervene, I can get in something, you're not going to have a flash crash type day where you're just, you're wiped out immediately. So if you're trading kind of with a manual mindset, you're going to be able to leverage that and scale that very well. So, and then you kind of take and see what works and you automate that process. So when I think of automated trading, I'm kind of automating my disciplines and my patience.
Okay.
Or my discipline and my patience, right? So I think, and we may have talked about this earlier in the video, but I think a lot of people focus so much on the idea generation, and what they do is they spend all this time back testing, and maybe they fit it, maybe they don't, but regardless, they're happy. Then they go trade it live, and it doesn't have the results that you want. So you get discouraged. You kind of start this process over again. I'm really of the idea and the camp that you need to, let's take what you have and let's see if we can make that a little better. Let's keep the good things. Let's get remove the bad things. Now you do have the argument of fitting that, but at the same time, that is your trade history. That's how you're reacting. So if we can kind of get an idea of, again, what you're doing well, what you're not doing well, I mean, that has huge potential, I think.
Okay. And we talked a little bit about at a certain time scale, the markets are pure noise.
Right.
And at a certain time scale, there's a lot of information.
Right.
Where do you think that barrier lies between where you're actually getting into real information?
Oh man, that's tough. It's kind of what you want, If you're wanting to day trade, you gotta realize that's more noise than signal, right? So I mean, but that being said, if you adjust your expectations, your risk, your reward, your time frame, your duration, I think that's still doable. But obviously, the longer you get out, the more I think accurate that information is. But you have to find what works for you, and you have to understand. That's kind of what we talked earlier about, working back from the nominal size, like positioning your trades based on the nominal amount.
Yeah, you don't keep your entire balance with your broker.
No, and I think, as you've always, and you alluded to Refco. I mean, if I'm going to trade 100 grand, yeah, I could trade 10 to 1 with 10K in my account, but to me, that's, I don't want my broker to have that money. Like if I'm not needing it to trade, there's no reason for me to keep the money in there. So think in terms of the nominal number. So if you want to trade 100K, if you want to trade $1 million, think, okay, I'm trading 100K, and you have the margin requirement, whatever your broker requires, and then I would suggest maybe keeping enough for 10 consecutive losses.
Okay.
So now you basically,
you're trading like giganto size.
Yeah, I mean, so you're trading. You work backwards from the size you want to trade. So people say, "Oh, you're using too much leverage." But if my money's just sitting in my account just so I can trade it, a smart leverage, I don't know how smart that is because, there's a lot of accounting tricks that are going on in these places, and not to say they're all bad, and none of them may be, but at the same time, if you don't need to risk that money by having it in your account, yeah, why do it?
Okay. So you trade a size that would be appropriate. So if you were trading a 100K account, you trade as though you had a 100K account,
right,
with 10 grand.
Yeah.
Something like that.
Yeah. I mean, you again, and two, like when you think of trading, think you're trading 10 million or 100 million. I mean, that's, as a big trader, you couldn't come in the market and try to place a $10 billion trade and expect to okay, I'm going to get in this price, have a 15 stop loss. I mean, it's not possible.
Right.
So I mean, I think if you take a step back from kind of the okay, here's my pip stop loss, and just realize that in 100K, one cent is 1%, So you might be thinking, holy crap, I just lost 100 pips in my trade. But from a nominal standpoint, you've only lost 1%. So by kind of thinking about it a little differently, I think it gives you a different perspective. And so you're not as, hopefully not. Maybe you just don't feel that pain as much as you would if you're like, man, I just lost $1,000,
So because you do have the software between you and the market,
right,
how does that help you emotionally?
Oh, it's night and day. I mean, so I basically go about my day. I will get an alert on my phone that says, okay, these conditions that you want to look at, that you've decided, over the weekend, are the conditions you want to see. This has happened. So, place a trade, don't place a trade. Okay. And then what I do is I essentially say buy or sell, which is kind of a gray box situation, and then my risk software will essentially decide where to place the order, if to place the order, and at what size.
Okay.
So that quick reaction, okay, buy, sell, I know that it's already, the market conditions are what I wanted already, so I'm not sitting there. A lot of times you'll have your rules, 9 out of 10 of them are right. The last one looks like it might be right, so you're like, oh, I'll go ahead and trade that, and then it doesn't, right?
Right. And
then you've essentially violated your risk profile and your plan. So by passively getting those alerts, and again, not not having the mindset of like just auto trading, like I have to get, like speed counts, price counts, okay, I want to get in. Yeah, I may miss it by 2 or 3 pips, but at the same time, if I'm putting my order down anyway, or up, then I'm not worried about that. I'm not worried about getting the execution right then and there. So, yeah, it gives you tons of peace of mind. You're able to, sit outside and enjoy, go somewhere you like, where you're not just, in front of the screen, kind of shoulders stressed out. I mean, it allows you to kind of relax a little bit.
And this software aside, you make your full-time income exclusively from trading.
Correct.
That pays for the house, the bills, everything.
Right. Well, I mean, my wife has a great job too. She helps.
That's cool. And then can you tell us a little bit about the software and where you find it?
So it's fxticker.com is the name. I don't want to push it too much, but I think it's something very valuable. I mean, you're able to get information. You can essentially say, okay, these are the conditions I want to see. Alert me when that happens. So you're basically, we're filtering the noise and giving you the signal is kind of what I like to say. And on top of that, we go back and we do post-trade analysis on your trade. So we'll look at, maybe, for whatever reason, I don't know, everywhere I've traded and everyone I've talked to, Tuesdays is like the day, right? I mean, I don't know why. I mean, I have my kind of speculations, but everyone I've talked to, Tuesday seems to be the most profitable day.
Okay.
So, I mean, even just based with that information, like if you find out Tuesdays is your best day, you're going to benefit from maybe taking your size to 2x, maybe doubling your size. I mean, something that simple. But, let's look at your trades from a different perspective. I mean, it's not all in the pre-trade. Find this great idea. Let's take.
It's not your magical signal.
Right,
it's what happens after your generic signal.
Exactly. Let's take your trade history and see what you're doing well, what you're not doing well, how you can improve. Also that's an iterative process. I mean, it's not something you can do once because the market's going to change. Like you mentioned early, you may find out that Fridays aren't your best day. But and the other cool thing is, even if you're in a situation you deny the trade, right, that still goes into the system as a time-stamped event. So it's not like it's just lost, right? So we may find out that Fridays come back into favor for whatever reason. So it's not like if you deny the trade here, that you kind of lose that information, right? Because you want to know if and when it comes back. So the benefit of having all the information, time-stamped, is we can look at your trade history, look at the market activity prior to that trade, and then start to extrapolate data that could potentially make your trades a little more profitable.
Excellent. So I think we'll wrap up there. So Bobby, thanks for joining me.
Thanks for having me.
And thank you for listening.